Welcome. So, in our world today, it feels like you can work from just about anywhere, right? But that brings up a huge question. Who actually gets to tax you when you do? Well, that's where this really important concept called tax source rules comes into play. Let's break down what they are and, why they matter so much.
I mean, really, picture this. You've got that dream job. You can work from your laptop on a beach, in a cool new city, maybe even a totally different country. It's amazing. But this dream creates a very real, very practical problem. When your work and your home are in two different places, which government gets a slice of your income?
And that exact question, well, it's at the heart of what we call the remote work tax puzzle. It's a challenge that, honestly, millions of us are facing now, and the only way to solve it is to understand the rules of the game. Taxes used to be pretty straightforward. For the most part, you worked where you lived. Simple. But now, with this explosion in remote work and global teams, those old lines are just completely blurred. Figuring out which country has the right to tax you isn't some minor detail anymore. It is absolutely critical to your financial life. So, how do governments even begin to untangle this mess? The answer lies in a really fundamental concept in international tax law, something known as source rules. Let's dig into what that actually means.
Okay, so at their core, source rules are basically just the set of principles a country uses to decide if income was generated inside its borders. It's not about where you live, it's not about your citizenship, it's all about where the economic activity, the actual work, really took place. Here's a really simple way to think about it, kind of like a pecking order. The country where you earn the money, where you are physically standing and doing the work, gets the first crack at taxing that income. They are first in line, period. So why should you care? Well, for governments, these rules are crucial. They stop tax avoidance and they help divvy up tax revenue fairly. But for you, for the individual, they're everything. They give you the clarity you need to navigate your taxes as a cross-border worker or an investor or a digital nomad. Okay, so the theory makes sense, but how does this all work in practice? Well, the rules are actually applied a little differently depending on the kind of income you're earning.
And when you break it down like this, the logic is actually pretty straightforward. Your salary, that's usually sourced to where you physically do the work. Income from a rental property, sourced to where the building is located. And investment income, things like dividends, that's typically tied to where the company paying you is based. See, it just follows the money. Makes sense, right?
Let's make this super concrete. Imagine an American engineer. She spends 100 days working on a big project over in Berlin. Now, even though her company and her home are back in the US, Germany gets the first right to tax the chunk of her salary she earned while she was physically working on German soil.
And here's another really clear example. Let's say you live in Canada, but you own and rent out a little apartment in Spain. Well, that rental income originates in Spain because that's where the apartment is. So Spain gets the first right to tax that income. Doesn't matter one bit where you live.
Now, I know what you might be thinking. Wait a minute. If the country where I earn the money gets to tax me, and the country where I live also gets to tax me, am I about to get taxed twice on the exact same income? And yeah, that's a totally valid concern. This is exactly where you can see the potential for a big conflict. On one hand, you've got the source country, Germany in our engineer's case, making its claim because the work happened there. But on the other hand, your home country, let's say it's Canada, wants to tax you on your entire global income. It's a direct clash, and both countries have a legitimate claim to that same money. Thankfully, there is a solution: tax treaties. These are basically agreements between countries that are designed specifically to solve this exact problem. They act like a rule book, and they often let you claim a credit in your home country for the taxes you've already paid somewhere else. It's a system designed to make sure you don't end up paying tax twice on the same dollar. Whew, okay, we've covered a lot of ground. But what's the single most important thing to remember from all of this? Let's boil it all down to the absolute core idea. Honestly, it all comes down to this. If you can just remember these three simple principles, you'll have a really solid handle on how source rules work. Work is taxed where it's performed. Property is taxed where it's located. And investments are taxed where the payer is based. That's the gist of it. And at the end of the day, this isn't just some academic exercise. Knowing where your income is sourced is the essential first step to managing your finances in this global economy. It empowers you, it lets you ask the right questions and plan ahead so you don't get any nasty surprises come tax time. And all of this leaves us with one final and really crucial question. These rules were designed for a world of physical offices and clear borders. As our work becomes more and more digital, more decentralized, how are these principles going to have to adapt? Well, that's the next big challenge for governments and for all of us.